I think the market's ready for a little bit of consolidation right here. It was a big move in a very short period of time. It bodes well for the rest of the year for sure, but there's a lack of a catalyst right now. And I think the biggest catalyst that we have going for us is Q1 earnings, which we won't get until April. I think they're going to be much better than expected. The current consensus estimate is for a decline of 2%. That's over a 600 basis point move since the beginning of this year downward. The last time we saw something like that, it was Q1 2015, and guess what? Earnings came in over 650 basis points better than expected.
So, Doc, you got Credit Suisse out today. They take their S&P view higher. They go to 3,025. They take their estimates lower, though.
Yeah.
They lower their earnings estimates for 19 and 20.
Yeah.
But yet they think stocks are going to go higher.
Yeah, and I'm one of them that would agree. One of the people that follows Credit Suisse that would agree with that, Judge. I think last Friday we closed below 13 in the VIX. That was one of our lowest closes in a long time. Is it terribly surprising? Not so much, because even though we're uncertain about how Theresa May's vote may go for her third attempt at getting a vote for Brexit, we nonetheless are looking at the possibility that enough of the firms that we really focus on as far as earnings, I think Carl mentioned Tilray tonight will be coming out with earnings, but we don't have that much left as far as stocks that will move the market with a good or a bad earnings report. And for that reason, I think it's natural that we see at the end of the season volatility is going down, because that's one of the big unknowns is how are stocks going to do. And they've pretty much come out in line with what we thought they would do. A little bit lower, but still good.
Pete, how much is left in the market's tank, you think?
You know, I think we still got a little bit more, Scott. And the reason I say that is I'm looking across, and I think the diversity of what we've seen out of this rally. I mean, I know last week we were focused on FANG, but I think if you really look at it, it's more than FANG. It's old school tech. It's the old names. It's Cisco. It's Oracle. It's Apple. It's all those names, Microsoft included. But also take a look at energy. Take a look at what's going on. The financials have very quietly been moving to the upside. Take a look at Goldman Sachs over 200. JP Morgan right now over 107. There's a lot of movement that really hasn't been covered a lot in terms of the diversity of how this market's been actually moving towards the upside. So I think because of that, Scott, I think there is a little bit more room. You look at some of these energy names, extremely inexpensive still. Look at something like an ExxonMobil. It's back up now. You look at oil itself towards 60. Exxon's back at 81, or right about pushing on 81. So we are seeing a nice move to the upside from other areas that we hadn't seen. And I think when you look at how inexpensive financials are, how inexpensive some of these energy names are, it makes sense that we still could have some room to the upside. I'm one of the believers that thinks that we do.
You want to agree with that or disagree, Sarat?
No, I actually agree with him. I think the point that if you kind of take together a couple of things that people have said here on the desk is, to your point about interest rates that are low, and if the Fed says we're going to keep them low, well, why do you think financials are doing well? Because now they're looking at the slope and saying, we talked about for months about the inversion, and now that inversion, unless the 10-year really comes down, is not really going to happen because the Fed is not going to do that.
The curve's still flat, though.
It's flat,
and it's flattening.
Yeah.
It's flattening. I mean, the spread between 2 and 10s has gotten tighter.
Right, but if you
yields aren't going anywhere.
But yields aren't going anywhere. But we're not going into inversion, and that's really important to the market. If that does happen, then you can have central banks on your side and bring rates down. That, I think, is a key indication. But the banks aren't doing badly. They're making money, and their valuations are getting lower and lower as they make more earnings.
So you think that it's time to get more bullish on stocks?
I think it's time. You don't have to necessarily just chase growth at this point. I think there's other opportunities in the market, such as industrial, such as financials, where the valuation is lower than the market. And if the market does pull back, you have some margin of safety.
So I talked to a big investor earlier today. I want to give sort of what I call the big money view of where we are right now, and then I want to debate it on the desk. Stocks towards the upper end of the range, I was told. Still better than bonds, though, because obviously what's been going on with bonds. Stocks aren't cheap, but not extremely rich either. And the buyback window is going to close soon, in a few weeks, because you have a blackout period ahead of earnings. Now, there's a bit of a push-pull. You could make a bullish case on some of those sentiments, Ron. You could say some things are negative. We've pushed towards the upper end of what this particular person thinks is the range that we're currently in.
And I think that's true until proven otherwise. I mean, again, we've seen this now for the third time, that we're pushing up against that upper band that we've seen on the S&P, that we've seen on the Dow, that we've seen on all the major averages. So this could be a massive one-year triple top. if you get some negative catalyst. And there's been some talk that there's serious progress being made on the China trade discussions as well. I believe Larry Kudlow came out and said that enforcement mechanisms were being agreed to, and so that puts a little more teeth into the agreement should there be one. But having said that, look, I mean, you've had a great year in 2.5 months. In every one of those groups. You know, Pete was saying that the oil services sector stocks are up. Don't forget, they were hammered last year. They've only gotten back about half of what they lost last year. So you're going to get some sort of rebound that's meaningful, tradable rally. I think, though, there are open questions as to whether or not you push meaningfully higher from here or you move sideways for a period of time. And as Lindsey was suggesting, maybe digest some of these gains.
There's good points. I mean, how do you get out of this range if we are in, say, 2,700 to 2,900? How do you bust out of that to the upside?
Well, see, I think when you think about valuations right now, the S&P 500 trading at 17 times, it's slightly above its historical average, but interest rates remain very low. Inflation is very subdued, so that warrants a higher multiple, if you will. But also, that multiple right now, 17 times, is on 2.5% earnings for 2019. And that is where the question mark lies. If you think that number is right, then maybe